Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of business, and let's just say Raymond James Financial had quite a few interesting things to report this year, including a massive amount of preferred stock that has got some floating interest rates. So grab your popcorn, because we're diving deep into their latest annual report to see what is really going on. We all want to know where the money is and how these big firms make it, right? Well, after you watch this, you'll have a much clearer picture of Raymond James's financial world. And hey, if you appreciate getting straight insights from corporate documents like this, make sure you are subscribed. We also have a Discord community linked in the description below where we talk about these things even more. Raymond James Financial is a big player in the financial world, offering everything from wealth management to banking and capital markets. They've been around since the 1960s and are publicly traded, which means they have to tell us all about their business every year. This report covers their performance up to the 30th of September 2025, and it's packed with details on how they did. Let's get into the nitty-gritty of their financial performance. The company reported a strong net revenue of $14.065 billion for the year ending September 2025. That is a solid 10% increase from the previous year, showing they're growing. Their net income available to common shareholders also saw a nice bump, reaching $2.130 billion, a 3% jump. While that might not sound huge, it translates to $10.30 per diluted share, a 6% increase compared to last year. This shows they are making more per share, which is generally a good sign. That is, return on common equity was 17.7%, which is pretty strong. Think of it like this: for every dollar of common equity they have, they are generating about 17 cents in profit. They also reported an adjusted ROACE of 18.3%, which helps paint a picture of their core business performance by removing certain one-time expenses. Now, not everything was a straight line up. Their non-compensation expenses, which include things like rent, technology, and legal fees, rose 16%. This was largely due to a $58 million increase in provisions for legal and regulatory matters, specifically related to a settlement from past bond underwriting activities. Also, they're investing more in technology, which is smart for the future, but costs money now. Let's talk about their bank segment. As of September 2025, their total assets in this segment were a hefty $65.26 billion. A significant chunk of that, about 46%, is in securities. Base loans. These are loans where the borrower uses securities as collateral. So how do these loans work? Well, essentially, borrowers use their own investments like stocks or bonds as a safety net for the loan. The bank then holds onto these investments, and if the borrower can't repay, the bank can sell those investments to get its money back. A big chunk of their bank loans, though, are loans held for investment, which means they intend to keep these loans for a while, earning interest over time. Looking at their financial health, their total equity attributable to Raymond James Financial Inc. was $12.503 billion in September 2025, up from $11.673 billion the year before. This growth in equity is a positive indicator of the company's financial stability and its ability to absorb potential losses. Now, we have to check in with the auditors. KPMG LLP confirmed that Raymond James's financial statements present fairly, in all material respects, the company's financial position. They also gave a clean bill of health to the company's internal controls, which is crucial for investor confidence. One of the things the auditors highlighted as a critical audit matter was the allowance for credit losses, especially in their commercial and industrial, or CCI, and commercial real estate, or CII, loan portfolios. This is basically the money they set aside for loans they think might not get paid back. Estimating this amount is tough because it involves a lot of guesswork about future economic conditions. They use complex models and forecasts, and the auditors had to spend a lot of time making sure those estimations were sound. The company estimated that if the economy took a turn for the worse, their potential credit losses on these loans could increase by about $170 million. That's a significant number and shows the uncertainty tied to lending during fluctuating economic times. Now, no company is immune to the risks out there, and the report doesn't shy away from them. One of the biggest concerns for any financial firm today is cybersecurity. They explicitly state that any cyber attack or security breach could lead to big liabilities and serious damage to their reputation. They're constantly dealing with cyber threats, from viruses to phishing attempts, and they're putting a lot of effort into protecting client data. It is a never-ending battle in the digital age. Their whole operation depends on keeping information safe and sound. Think about it, they handle tons of sensitive data for millions of clients. A breach could mean huge financial losses for clients and massive legal trouble for Raymond James. They are also relying heavily on third-party vendors for services, like cloud technologies. which means they are also vulnerable to the security weaknesses of those vendors. Another big risk they flag is liquidity. If they can't get enough cash to keep their businesses running, it could be a major problem. This means if they can't borrow money or their subsidiaries can't send cash up to the parent company, they might have to scale back operations, sell assets at a loss, or even cut those shareholder dividends we all like to see. And then there is the ever-present threat of lawsuits and regulatory actions. The financial industry is a magnet for these, and Raymond James acknowledges they're exposed to a lot. They mention they could face significant liability from legal and regulatory issues, which can drain resources and damage their reputation. Let's look at their expenses. Compensation, commissions, and benefits are their biggest cost, running at $9.072 billion for the year. This is a 10% increase from the prior year, largely driven by higher revenues and ongoing investments in hiring more financial advisors. Their compensation ratio, which is how much they spend on compensation relative to their revenue, is 64.5%. This means for every dollar of revenue, about 64.5 cents goes to paying people. It is a bit higher than last year, but still within a reasonable range for the industry. They also pay close attention to pay equity, conducting studies to ensure fair pay across genders and races. One interesting part of their compensation structure involves stock. They have a stock incentive plan where they grant restricted stock units or RSs to employees, directors, and advisors. These are like promises to give them company stock in the future. For the year ending September 2025, they granted 2 million shares worth about $162 per share, showing a clear commitment to tying employee rewards to the company's success. They also have an employee stock purchase plan, allowing employees to buy company stock at a discount, which is a nice perk and helps align employee interests with shareholders. Financially, they issued a substantial amount of senior notes. In September 2025 alone, they issued $650 million in senior notes due in 2035 and $850 million in senior notes due in 2055. That is a total of $1.5 billion in new debt. This shows they are actively managing their capital structure and likely funding growth initiatives or acquisitions with this debt. Overall, Raymond James Financial is a massive company with a lot of moving parts. They're growing in many areas, particularly in asset management and their banking segment. They're also making smart, albeit costly, investments in technology and cybersecurity to stay competitive and protect their clients. The risks are definitely there, as with any financial institution, but their strong equity position and access to capital suggest they are well equipped to navigate these challenges. They are clearly focused on long-term growth and putting clients first, which has served them well historically. What is your take on these numbers and what they signal for Raymond James Financial's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. Don't forget to check out the Discord in the description. Thanks for watching. See you next time. Hey everyone. Welcome back to Corporate Decoder. In this video, we will talk about Raymond James Financials Inc. Latest 10K report, their annual financial report for the fiscal year ending the 30th of September 2025. A report that shows some significant stock buybacks and a hefty amount of senior notes issued. Before we start, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we talk about these things even more. Raymond James Financial Incorporated is a big financial services company that does a lot of different things. They help individuals manage their money, work with companies on big deals like mergers and acquisitions, and even offer banking services. They are headquartered in St. Petersburg, Florida, and their stock trades on the New York Stock Exchange under the ticker symbol RJF. This report is their annual checkup, telling us how they did financially over the past year up to September 2025. So let's get into the numbers. For the fiscal year ending the 30th of September 2025, Raymond James Financial brought in $14.065 billion in net revenues. That is a 10% increase from the year before, showing their business is growing. And growing revenue usually means more profit. Their earnings per diluted share, a key measure of profitability for shareholders, came in at $10.30. This is a 6% increase from the previous year, indicating that the company is becoming more efficient at turning revenue into profit for each share of stock they have outstanding. They also report something called adjusted ROTCE, which stands for adjusted return on tangible common equity. This adjusted number was 21.3%. A higher ROTCE generally suggests a company is using its tangible equity very effectively to generate profits. For Raymond James, this figure, while slightly down from last year, still indicates a very healthy return on the capital they are actually using to operate their core business. Now, expenses are a big part of any business. They're non-compensation expenses, meaning costs that aren't directly tied to paying employees or commissions, went up 16%. A major reason cited for this jump was a $58 million increase in provisions for legal and regulatory matters. This suggests they had to set aside more money to deal with lawsuits or regulatory issues, which is never a good sign, but common in the financial industry. They are also increasing investments in technology, which is a smart move for long-term growth, but adds to short-term cost. Looking at their financial foundation, as of the 30th of September 2025, Raymond James Financial had total assets of $88.230 billion. This is a $5.24 billion or 6% increase from the previous year. This growth is largely driven by an increase in their bank loans, which went up by $5.57 billion. This signals expansion in their lending activities, a core part of their banking business. Their bank deposits also grew significantly, increasing by $2.89 billion. This influx of deposits is crucial for funding their lending operations and shows that clients continue to trust the company with their money. To fuel some of this growth and manage their capital, the company issued a large amount of senior notes. In September 2025 alone, they sold $650 million in senior notes due in 2035 and $850 million in senior notes due in 2055. That is a total of $1.5 billion raised through new debt. This move is likely to fund ongoing business needs, potential acquisitions, or simply to strengthen their liquidity position. Now, running a financial giant like this comes with a ton of risks, and the report spells them out. Cybersecurity is a massive concern. They acknowledge that any breach could lead to major liabilities and seriously harm their reputation. They're constantly battling cyber threats and are heavily invested in protecting client data. Another major risk they highlight is liquidity. They need to make sure they always have enough cash on hand to operate, even during tough times. If they can't access funds, they might have to sell assets at a bad price or even cut dividends, which is never good news for shareholders. And of course, the auditors KPMG LLP have weighed in, giving the financial statements and internal controls a clean bill of health. That is always reassuring to see. However, the auditors did flag the allowance for credit losses, particularly in their commercial loan portfolios, as a critical audit matter. This means estimating how much money to set aside for bad CCI and commercial real estate loans requires a lot of judgment. They're using complex models that forecast economic conditions, and they acknowledge that a downturn could mean significant potential losses. This is a reminder that even with strong financials, the lending business always carries inherent risks tied to the broader economy. Based on these numbers, Raymond James Financial seems to be navigating the complex financial landscape reasonably well. They've grown their revenues and profits, and their equity base is solid. They are actively managing their capital, issuing new debt to fund their operations and growth. However, the increasing legal and regulatory provisions, coupled with the ongoing cybersecurity risks these firms always face, are definitely areas to watch. The company's focus on client assets, especially in fee-based accounts, is a strength but also ties more of their revenue to market performance. Their expansion in banking also means they are more exposed to interest rate fluctuations and credit cycles. The business is growing, but it is important to keep an eye on how efficiently they are managing their expenses like compensation and those growing non-compensation costs, especially the legal ones. What is your take on these numbers and what they signal for Raymond James Financial's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.